How did Wall Street wealth managers legally engineer ways to take up to a third of your lifetime returns? This is the definitive masterclass on the hidden fees of institutional wealth management, revealing the history and evolution of Wall Street's most profitable shadow industry. Here's the strange part. Nobody ever sends you a bill. When the dentist fixes your tooth, you get a bill. When you buy a pizza, you see the price right there. But a money manager works a different way. They take their fee before you ever see it. They pull it straight out of your account, a little at a time. Most people never even notice it leave. Say you have $10,000 invested. Your advisor charges 1% a year. That's 100 basis points in Wall Street speak. That is $100. It does not sound like much, does it? And in most years, your account still goes up. So you never feel a loss. You just end up with a little less than you should have. That tiny gap is the whole trick. It feels like nothing, but over many years, it turns into a lot. Now picture that same small fee for 30 or 40 years. The money you give up is not just the fee itself. It is also everything that money could have earned if you had kept it. A man named John Bogle spent his whole life trying to get regular people to see this. Most of them never did. The fee was built to be easy to miss. Quick thing before we keep going. If this is already opening your eyes, tap subscribe to Beth Builds Wealth so you don't miss the rest. Give the video a like and share it with someone you know who has money invested. They are going to want to see this. 1% sounds tiny, but let's look closer. That 1% is not charged only on the money you made. It is charged on all of it. Every single dollar you hold, your total assets under management, or AUM in industry terms. And it is taken every year, even in the years your account goes down. So in a bad year, when you already lost money, you pay the fee anyway. Here is something else most people miss. As your assets under management grow, the fee grows too. Say you save for years and build up $500,000. At 1%, that is $5,000 a year. But your advisor is not doing 5 times more work than when you had $100,000. The job is mostly the same. You just pay a lot more for it. Now the biggest part of all. Money makes more money over time. People call this compounding. When a fee takes a slice each year, you don't just lose that slice, you also lose all the growth that slice could have made for the rest of your life. Stretch that over 40 years, and the gap can reach hundreds of thousands of dollars. This is the quiet power behind the hidden fees of institutional wealth management. Not one big charge, one small charge taken again and again. The 1% you pay your advisor is usually not the only fee. There is another layer hiding under it. Here is how. Your advisor takes your money and puts it into funds. A fund is just a big basket of stocks. But every basket has its own yearly fee called an expense ratio. That fee comes out before the money ever reaches you. So you pay your advisor 1%. Then the funds they picked charge you again, maybe another 0.5% or more. Add those layers together and you get what the industry calls the total expense ratio, or TER. The real combined cost of what you are actually paying. You are paying twice, and you may not even know it. Inside many of those funds is an even smaller fee with a strange name. It is called a 12b-1 fee. Back in 1980, SEC Rule 12b-1 let funds charge it to pay for their own advertising. The idea was simple. If more people joined, the fund would get bigger, and then it would get cheaper for everyone. Well, the funds got bigger, but the fee never went away. So today, you are still helping pay for the ads that pull in the next customer. In the old days, the fees were even more blunt. Some funds took a big cut the moment you put your money in. This was called a load. It could be almost 6% gone before your money did a single thing. These days, the industry uses softer words like advisory and wrap accounts. But a wrap account just bundles all the fees into one number. That does not make the fees smaller. It only makes them harder to count. So far, we have talked about fees you could find if you went looking. Now we get to the ones you can't see at all. These never show up on your statement, and that is on purpose. Start with something called revenue sharing. A fund company will pay your broker to keep its funds on the shelf. So the fund that lands in your account may be there for a simple reason. The people who made it paid to put it there. You still cover that cost. It just gets hidden inside fees you were already paying, so there is nothing for you to point at. Next is a thing called payment for order flow. When you buy or sell, your broker can send your trade to another company that pays them for it. Financial Industry Regulatory Authority, FINRA, and the Securities and Exchange Commission, SEC, require brokers to seek best execution on your trades, but that deal still happens in a place you never get to look. You just trust that you got a fair price. Then there is your spare cash. The money sitting in your account, not yet invested, often gets moved into a bank the firm owns. That bank pays you almost nothing, but it earns more than that, and the firm keeps the difference. None of this is against the law. It's written down somewhere in papers nobody reads. But here's the thing they all share. The firm gets paid whether you win or lose. Their job is not really to grow your money. Their job is to gather it and keep it moving through their own system. And here is something most people do not realize. Most advisors operate under what is called a suitability standard, not a fiduciary duty. That means they must recommend something suitable for you, but not necessarily what is best for you. A fiduciary is legally required to put your interests first. Most advisors are not fiduciaries. Your advisor can be a kind, honest person and still work inside a machine that is built to profit from you. Let's put the pieces back together. 1% to your advisor, 0.5% or more inside the funds, a little more in the hidden flows. Add it up, and you might be paying close to 2% every year. That comes out of everything you own, in good years and bad. Now think about what that does. Say your money could grow about 7% a year. If 2% is taken off the top, that is not a small trim. It is almost a third of your growth, gone every single year, year after year. Here is the comparison the industry would rather you skip. There are simple funds, called index funds, that hold almost the same stocks. These are passively managed funds. They just track the market automatically. The actively managed funds your advisor likely picked are run by teams of analysts trying to beat the market, and you pay for all of that. But here's what makes it worse. Most actively managed funds do not beat the market over time, so you pay more and often get less. Passively managed index funds charge close to nothing, not 1% stacked on another. We are talking a few pennies on every $100. Same companies, same market. The big difference is just the fee. Over a lifetime, that gap can be the difference between retiring on time and working years longer. So go back to the question we started with. How did Wall Street wealth managers take up to a third of your lifetime returns? Now you know. Not with one big charge you would notice and fight, with many tiny ones, taken quietly, built to be easy to miss. The fees were never really hidden. They were just placed far away from where you were looking. If this opened your eyes, do 2 quick things. Subscribe to Beth Builds Wealth because we break down money stuff just like this every week. And share this video with someone you care about who has money invested. This is the kind of thing they will thank you for.